Welcome back here with ET Now. This is the second leg of the India development debate, and we're putting the spotlight on the state of the economy. All is not well with the Indian economy, with crude oil prices hitting $80 a barrel in international markets and the rupee continuing its downward spiral. Fault lines are fast emerging. The spike in crude prices have already dealt a body blow to the economy, with petrol and diesel prices touching all-time highs. The immediate result is a rise in consumer inflation, which is now ruling well above the RBI's midterm target of 4%. Economists fear high inflation could put pressure on the Monetary Policy Committee of the Central Bank to raise benchmark rates when it meets in the first week of June.
Indeed, it is a raw deal for the consumers and the market. An interest rate hike at this juncture could dampen investor sentiment at a time when the markets are seeing big outflows. The government is, however, putting up a brave face for now. Economic Affairs Secretary today said that the currency situation is completely under control and asserted that the surge in crude prices will have a maximum impact of up to $50 billion on the fisc. He, however, did rule out a cut in excise duty on petrol and diesel, which could lessen the blow. The fault lines on the Indian economy is a big topic of discussion right here on the India development debate tonight. And joining us on the show this evening is a stellar panel. V. Anantha Nageshwaran, independent consultant, Vanside Consulting, SK Ghosh Group, Chief Economic Advisor, SBI, and of course Maithili Busnurmata, Consulting Editor. They all join us here. And before I go headlong into this discussion, I think just for the benefit of our viewers, it's important to put things in perspective. Why are we debating this today? Because every $10 increase in oil prices worsens the current account deficit by 0.4 of a percentage point of the GDP. It hurts growth by 15 basis points, hikes inflation by about 30 to 40 basis points, and worsens fiscal balance by 0.1% of the GDP. So it's important for viewers to understand why this discussion is so important and why it's important to take stock of the Indian economy right now. Maithili, let's begin with you. The one thing that we had going for us perhaps was macroeconomic stability. Our twin deficits were under control. Growth was just about beginning to pick up. You know, we had this huge bonanza from oil. Is that now at risk?
Well, yes, certainly it is at risk. One is only hoping it does not, the balance does not tilt too much against us. Because if you look at the health of an economy, you can look at it in terms of broadly three parameters. The external balance, which is measured by the current account, the internal balance, which is measured by the fiscal deficit, and in a country like India, a third important parameter is inflation. Now, if we look at three of those two parameters, both the external balance as well as inflation have moved against us. The current account deficit is over 2%, is likely to reach 2.7% in this particular fiscal. The inflation level, both the consumer price inflation as well as wholesale price inflation have moved up. The wholesale price inflation, which reflects oil price much more sharply, has gone up even faster than the CPI. The only number that currently seems to be not under threat at the moment, and I repeat at the moment, is the fiscal deficit, which government has said it will maintain. But as oil prices continue to rise, and oil pricing in India is always a heavily political decision, then in that case the government will be really torn between two extreme positions. Does it allow the price hike to continue to go through to the consumers and risk inflation, or does it take a hit on the fisc and thereby risk the fiscal deficit? So as you put it in very well in a nutshell, in fact, a hike in oil price, particularly along with the depreciation of the rupee, is not good news for India at all. So the macroeconomy is in much worse position than it was about a year ago, and that's not good news for an economy for a government going into an election with just about a year to go.
Yes, absolutely. Now, Shomokanti Ghosh, crude at 80 rupee, precariously close to the lows of 2013, depreciating about 6% this year. Is the situation as bad as it was in 2013? Again, on the current account, at worst it could go to 2.7, 2.8%. So it's significantly lower than what it was in 2013. But yet, given the other issues surrounding the economy, is it as bad as it was in 2013? We do have forex reserves at 10 months of import cover. So does that offer significant comfort? I mean, how different is it from the situation in 2013?
No, first of all, I would like to say that we are far better than in 2013, but there are some small numbers I would like to say to the viewers. Is that in 2013, during the period June to August, if you look into that period of taper tantrum, there was a capital outflow, portfolio outflow around 13 billion. I think it's close to 14 billion. This year, in April till May 17th, I think yesterday the capital outflow, the portfolio outflow has been 4.7 billion. So at this rate, I think the outflow in May of this month could be the highest ever from June 2013, when it was at 7.5 billion. So that's a matter of concern, of course, that there has been a significant amount of capital outflow. So that is going to put pressure on the domestic fundamentals. That is going to, as Supriya said, on the current account deficit, even though the current account deficit currently, which is at 1.9% this year, could rise up to 2.5%, which is still sustainable, maybe around 30-40 basis points. But I am a little bit concerned about the fiscal front, because currently petrol prices are at 82 rupees, and there is a limit to which the consumers can absorb the prices in a year when the elections are due. And every 1 rupee cut, so even if you were to cut down the petrol prices from 82 to 80 rupees, assuming everything is constant, that could add an 25,000 crore impact on the fiscal side. So it remains to be seen how long the government holds back on not hiking on cutting the excise rates. Till now, the good thing is that till now, if you look into the comparative picture from June 2017 till date, the impact on inflation has not been that significant as the market was expecting. Perhaps because of the fact that most of there has been the price increase has not been passed on. So if you look into the bus fares, the other fares, even the auto taxi, I think there is still an holding back. So that's one good thing which is happening. But it remains to be seen how resilient we are and how long we can hold, at least in terms of the excise duty cut is concerned, even if I am not concerned about the other changes.
Right, right. Okay, Anand, I'm going to come to you and help us paint for us the worst case scenario for fiscal year 19. How bad can it get as far as the macroeconomic picture is concerned?
Well, I mean, if you want to paint a very bad picture, one can do that, because we could basically simply say that it will be as bad as 2013, which we know is not going to happen, because the inflation is not in double digits and the current account deficit is not going to be going to 4%, and the fiscal deficit is not uncontrollable either. So certainly that was a very classic overheating in every sense of the word. We don't have that scenario here because of subdued credit growth in the bank, credit growth in the economy, etc. So one can paint a very dire scenario, but that is very, very unlikely. But it is still a bad scenario, as Maithili put it in her opening remarks, simply because as the RBI continues to engage in open market operations, as government bond auctions fail, given the yield is not picking up, and if the RBI continues to keep a lid on the yield, then certainly it will have a spillover effect on the inflation rate as well, the liquidity, along with the oil price. And that can sort of continue to push the economy towards a stagflationary scenario. Because on the other hand, RBI will try to raise interest rates, and on the left-hand side, it will be doing the OMO to keep the long-term bond yield down. And if the oil price does not come down very quickly, it will then have a spillover effect on the rupee. And we do have, as per the September 2017 net international investment position, about $120 billion are due for repayment within 1 year. And I'm not including the NRI deposits in this. So yes, you can have a fairly significant impact on the rupee, even if it is not to the extent we experienced in 2013.
Fair point indeed. Shaumakanti Ghosh, I think it's evident that the trigger for this sort of macroeconomic instability is, of course, the movement in crude oil prices, the sharp movement. Is the threshold level of crude for India's macroeconomic stability around $70 to $75 a barrel? And the concern now is because we're at 80 and we don't know which way it's headed. I mean, it's very difficult to predict the movement of crude prices. Some commentators are talking of it getting to levels of $90, $100 a barrel. So is the threshold level for India at about $70, $75 a barrel? And the moment it crosses that, things get a little worrying.
No, I think, Sandeep, before I answer your question, I would just like to play a devil's advocate over here. I think, yes, oil is, I think we should also put that on the table for our viewers to understand. Yes, oil is an important driver of the economy, but I think there has been also a debate which is still unexplored in the Indian context, and which has been kindly by the famous economist Kenneth Rogoff in 2006, when he said that oil is not the only driver of business cycle. So taking that factor into consideration, if we actually see the oil prices movement from 2004 onwards till the time in 2017 June when it started rising, the oil prices actually has crashed at some point of time, and that did not lift the global GDP growth materially. So, whether oil is still an important factor in the business cycle in the Indian context, that remains a factor to be seen. Now, having said that, to answer your question of the oil, I mean prices at where the market could take a little bit of discomfort, I think that number could be around say $75 to $80 per barrel. If you just take an average, the average crude dollars per barrel as of now, as we calculated today, it was around $69 per barrel. So, it is already over the RBI assumption of $68. So, how long it remains at 80, whether it goes to 90, bounces back, that will be the matter of conjecture, because because ultimately what we will consider is the average prices. So, if the oil prices comes down from this level, and there is a tendency in the global market, oil prices, if you look to the trends of the last couple of years, oil prices have always rallied in the first half, second half they have somehow tried to melt down. So, if on an optimistic basis I assume that happens, that could put some amount of the normalcy in the market, but beyond $75 to $80 per barrel, I think it will be difficult for India to be on the sustainable path.
Okay, it will be difficult beyond 80, and perhaps it's also going to be difficult for RBI to not act with crude at 80. And Maithili, you know, the last reading of CPI was at 4.58%, and we had this chat then, crude at 80. Is it wrong to assume that the RBI will increase rates in its next policy, and if so, by how much?
Well, I am a strong advocate of the RBI actually, going in for a rate hike in June itself for two reasons. Apart from the oil hike, there also is the fact that we have been seeing an outflow of FPIs, foreign portfolio investment, and the RBI in fact had acted earlier about a month ago to try and incentivize flows into the country by making it much easier for bond investors. Despite that, there have been outflows. So, the RBI is seriously concerned. Remember also in June, we are going to see the FOMC, the Fed Open Markets Committees, hike interest rates as per their schedule of about 25 basis points. So, in such a scenario where the RBI's repo rate is way behind the market rate, I think the RBI purely, at least if only to bring its rates in alignment with the market, will have no option but to raise interest rates. Remember, monetary policy must be preemptive. There is no point acting after the event. An RBI under the inflation targeting regime has always tended to be more rather than less hawkish. So, I would think that the RBI is strongly on course to raise interest rates in the June meeting itself and not wait till August. 25 basis points in June is my call.
Basis points in June is Maithili's call. Ananta, if and when rates are hiked, do you expect it to be a short rate hike cycle? And will the nascent recovery that we're seeing in the investment cycle be choked off by higher rates? Is that another, problem area for the economy?
Yeah, I mean, I don't envy the RBI's choices at this point in time. But if I were in their shoes, and I know it's a very tough call, so without much certitude, but one has to take a call, I would actually look through the oil price and not hike interest rates, even if the FOMC were to hike interest rates in June. Because all said and done, the global economic cycle is at its very, very mature phase. So purely from a macro perspective, the oil at this level is unsustainable going forward. But what is sustaining it is obviously the political developments in the Gulf region. And therefore, and of course, India has a inflation target range between 2 and 6%, and all that is required is for them to write a letter to the Ministry of Finance. At this stage, if I were the RBI governor, I would rather write a letter than act preemptively, because underlying Indian economic trends are still relatively fragile. We don't know how much more bad debts will be disclosed because the RBI has tightened the norms, etc. And I think it is still a very fragile macro recovery and stability. I think for the time being, I would take a call and try to look through the oil price if I were in their shoes. But that said, let me reiterate, one can't fault them if they choose to raise interest rates, as Maithili advocates.
You raised the question of the fiscal deficit, Maithili. You did indicate that you're not as worried about the fisc as you are about the current account and, of course, the inflation. But the fact remains that the fiscal deficit target of 3.3% of GDP for FY19 looks a little challenging. I mean, look at what's going to happen between now and then. MSP hikes are going to start pinching. And at some point, the government will have to give some relief to consumers by lowering excise duty on petroleum products. They've resisted the temptation. Even today, you heard the Economic Affairs Secretary say that we are not looking at that option. But at some point, that option is going to come back on the table. So, are you worried about the fact that we are likely to see some slippage through the course of this financial year?
Oh yes, what I said was the fiscal deficit is not a source of worry at this particular juncture. But as we approach the elections, the government is likely to loosen the fiscal tap, particularly if oil prices remain high and if they're bound to increase the MSPs. Because remember, it is rural India that really decides who sits in the Prime Minister's chair, because that's where the votes really come from. So there will be some slippage, particularly if oil prices remain high. And going back to the point that Somukanti raised, yes, liquidity is a problem, but many of the problems are our own creation. Look at the kind of strictures the RBI has put on banks. Where is the credit creation? So unless you have credit creation, that also acts to liquidity. In some cases, the RBI has put strictures even on deposit mobilization by banks. So I think the RBI is being very short-sighted. OMOs can only do that much. Ultimately, the reason why banks are shying away from the bond auctions is simply because they do not want to take a hit. They do not want to invest in government securities. The entire time is right now spent in battling the CVC, the CBI, and answering n number of questions. So you really ensure that there is a complete squeeze on liquidity, complete squeeze on credit creation. So ultimately, I think the RBI needs to take a much more holistic view and ensure that because you have such a squeeze on credit, it's going to impact both growth as well as your bond auctions. So I think you really need to take an overall view of liquidity, and this is where I would point a finger at the RBI, not so much on their rate action, which I think they will perhaps hike because they tend to be very hawkish, but I think they need to do much more and look at credit creation as a very important instrument of growth as well.
Okay, Maithili made this mention about depends on who the Prime Minister will be, and monetary policy is a function of that because that's where rates are decided. But Anand, how concerned are you as far as the last year, the election year is concerned? Because this is a year where governments tend to turn populist. We've already seen MSP hike. We've already seen the farm loan waivers. We are a year away from 2019 general elections. And by the looks of it, politics is top of mind for just about everyone in that space. Now, while this government has been very prudent, and its worst critics are going to grant it that with the macroeconomic policy, is the temptation to turn populist far greater now than ever before?
I think the short answer to your question about whether the temptation is high, I think the answer has to be yes, because what happens in Karnataka is still kind of confirmation that if they get their act together through pre-poll alliances, they can stop the BJP. And that will probably play out in Madhya Pradesh and Rajasthan, etc. And if those results do not go in favor of the BJP, that sense of desperation will pick up. And then you will have a mini version, I would still call it a mini version of 2013, a pickup in fiscal spending, and possibly a slippage in the fiscal deficit, and that will play itself into the current account deficit, and with the RBI doing open market operations, and if by then crude oil price had not come down really, you will have an inflation pickup notwithstanding rate hikes and a disorderly depreciation in the rupee. So I think this configuration of outcomes is still very possible. In fact, it is moving from the possible to the probable bucket. And that is what I'm worried about. I think the Indian rupee weakness at this point is an orderly one, and it is what the government and the industry and the private sector wanted. And so far it is so good because Indian rupee has held up far better than other currencies in the last several years since 2013. But if it turns into a disorderly depreciation, then it will have a sort of a reinforcing spiral, and especially with all the oil price remaining where it is and the repayments falling due, short-term external debt falling due, etc., it could then turn into a disorderly and a bigger depreciation, even if it is not on the scale of 2013. So I think that slippage risk can create a whole lot of other snowballing effect into a mini classical overheating scenario that played out in 2013.
So we could look at a mini 2013 crisis-like situation, says Anantha Nageshwaran. But to strike a slightly positive note as we look to wrap this debate, Shaumakanti, structurally is the economy in a better place today than it was a year ago? Recent high-frequency economic indicators suggest economic growth is gradually improving. CV sales, steel output, cement output, tourist arrivals, etc., are showing improved growth. In a sense, is it going to be a sort of tug-of-war year between good micro and tough macro?
No, I tend to agree with you. I think the economy has structurally transcended a lot of boundaries in the last couple of years. The GST, the structural changes which has happened, the formalization of the economy, and even if you look into some of the vehicle sales, and also the most important thing is as the asset cleanup, so which is currently happening. So I think all this has been positive policy changes, but the only downside to these policy changes is that these are all long term in nature, so that will actually take some time for the results to come in. So we have to be a little patient, but given the fact that we are first approaching an election year, I don't know how this patience will play out with this micro and macro story, because at the end of the day, all of us needs to be, everybody on the ground will actually look into how he or she is satisfied in terms of the overall reality. So my sense is that even though the economy currently is on a sound footing, there is a lot of positives which is coming out of it. We need to manage some of the market idiosyncrasies a little better. For example, as Maithili just said, every day 15 basis points movement in yields is actually destroying the entire bond market. So these are some of the things which you have to take care of very carefully. Otherwise, the growth story and the structural part of the story remains largely intact.
Right. All right, Maithili, let's give you the last word on this then. And in retrospect, does it feel like India squandered the windfall that it got on account of unusually low crude oil prices, that we didn't use the last 4 years to build competitiveness for our exports, so that we could have perhaps paid for the crude that we import?
Well, I wouldn't put it quite so harshly, Supriya. The fact is that yes, we are far better than we were in 2013, but are we as good as it can get? Certainly not, partly because, as Somu said, many of the measures that the government has taken are long term. But on the rupee alone, I do feel that the government did squander an opportunity, because we should have allowed the rupee to depreciate earlier. Now the depreciation is much too rapid, and though it has been fairly organized and orderly as so far, the fact is the rupee was overvalued. So that hurt our exports. So otherwise, broadly, I would say the economy is in better health than it was earlier. But many of the benefits of the government, of the measures that the government has initiated, we will see the benefits much after 2019. And that really, in a democracy, is very worrisome for a government, particularly when the external forces, as in oil prices and the global economy, geotensions, all those turn against us. So we've been a little unlucky that it should have hit us at this particular juncture, but certainly this is something that is largely out of our hands. But as we approach the elections, government is going to get much more populist, and that will not be to our advantage.
Oh yes, that will not be to our advantage. Maithili, thank you for summing it up so beautifully as always. Shaumakanti Ghosh and Anantha Nageshwaran, thank you for joining us with that perspective on this edition of the India development debate. Like Maithili pointed out, the risks to the economy are largely on account of factors that are out of our control, but fundamentally the economy remains strong. Inflation risks are there, but it's being contained, and growth is looking like it will soon hit the takeoff point. But oil, of course, which is the big source of concern, the big lever for macroeconomy, could threaten some of that revival.
That's so true, because we have been the big beneficiaries of a benign crude regime, but it's time for more proactive and innovative intention, both on the fiscal and the monetary front, to not just deal with rising crude, but also its impact on inflation and, of course, the rupee. After all, keeping the economy in the pink of health has to be divorced, and irrespective of what happens in the world of politics. Thanks very much for being with us.